Hello, everyone. It's Nichole Jordan. I want to welcome you to our Market Intelligence Update podcast. And in this session, we are featuring our service line offerings and some additional value for clients with the theme around preparing for an economic downturn. Really pleased to have with us today our Chief Economist, Diane Swonk, and Robert Schwartz, who leads our performance improvement practice. Diane and Robert, welcome.
Thank you. It's good to be here.
Very good.
Thank you, Nichole, and likewise.
Absolutely. Looking forward to our conversation today, and why don't we dive right in. Share with us some of the factors that are triggering the downturn, and perhaps between the expertise of both of you, Diane and Robert, we can also tie this back to the questions that our teams ought to be prepared to engage with our clients around, and how we can help them through our service offerings, and Robert in particular in your service line practice. But why don't we start it off with the broader discussion around, pardon me, the factors triggering the downturn. Diane, can we start with you?
Sure. Right now we don't have a downturn, but we do have a lot of red flags that we're watching, and one of the most notable is one that just occurred in July, and that is the New York Federal Reserve has what it calls a recession indicator, and every time it's gone above 30%, we have seen a recession follow it at some period in time over the next year, and it went above 30% to 33% in the month of July. One caveat, of course, is that recession indicator is heavily dependent on an inversion in the yield curve. That's when, 10-year bond actually is lower than short-term 3-month Treasury bills. And there are a lot of reasons why the yield curve may be inverted that are not like the past. That said, perception is reality, and markets read that indicator very seriously, and we've learned over the years, and especially in this particular cycle, how important psychology is. And there is a couple of other factors that have shifted that are really notable. The Fed probably did overshoot in December, and so they're going to cut, although that's not a unanimous decision within the Fed, preemptively. That said, that's what usually triggers a recession. Consumer debt's not much of an overhang yet. Overhang of corporate debt is really a problem. We do have some emerging bubbles out there, and we have policy missteps in trade that could, rapidly deteriorate into a recession if we don't reverse course from where we are today. The effects of tariffs and the trade wars we're seeing are sort of like a snowball at the top of a mountain, and they accumulate over time as you roll downhill. And that's something that we're watching very carefully, because the worst of the effects of the disruptions to the global supply chain are expected to hit next year, 2020. That's at the same time that we could see our own fiscal problems in the U.S. and a showdown over the debt ceiling and things like that, slowing growth with actual spending by the federal government slowing instead of accelerating. In fact, we have very little, even though both the Republicans and the Democrats would like to boost the budget, they'd have to boost it a lot from where we're at to not have it be a drag on growth next year. Just holding the line on spending where it's at, which is already elevated from fiscal year 2018 and fiscal year 2019, you actually shave 0.5% off growth by mid-2020 alone. So we have these issues out there, and then red flags like housing market has already peaked. It can peak several years before the economy actually goes into recession. It peaked in 2006, and we didn't have the crisis until 2008. That said, housing market peaked in 2017. Vehicle sales have also peaked, and even though the consumer is looking like a bit of an atlas, it still has not regained the mojo we once saw before this particular expansion, the post-crisis expansion, which is notable as well. So then we have all the unknown, contagion effects of a hard Brexit, which looks much more likely now. Although Europe thinks they can weather it, it's very bad for Ireland, and nobody really knows, again, what the confidence issues are. We've seen a major indicator of recessions is CEO confidence dips below 50% in 4 of the last 5 recessions. and that's including one of them is kind of a little bit of a fudge because one of those recessions was 1980, 1981, 82. There was barely time to recover, let alone dip back below it. But that's happened again in the last 2 quarters, meaning they're believing the world is going to contract on their businesses instead of expand. The other issue is what we see in consumer attitudes. Consumer attitudes are still buoyant. Consumers are, still spending, but their attitudes about current economic conditions, those have improved while their attitudes about the future have plateaued and started to deteriorate. And that makes them much more vulnerable to a negative news shock. And we saw the cautionary tale of December when we had financial markets collapse and there was a fear the Fed was asleep at the wheel, a fear of trade wars, escalating tensions with China, and all things seemed to come to a head. And even though consumers were in really good shape, they pulled back during the height of the holiday season. And actually, we saw a contraction in retail sales. And so and we also saw a sharp slowdown in orders as well. So the hesitancy that comes at this late phase of the state expansion is the exact opposite of what we'd like. We'd like to see confidence instead of caution in the way consumers and businesses spend. So those are the things we're looking at when we think about the red flags out there and what could get us into problems in 2020.
Thank you, Diane. Great insights. And Robert, if we could turn to you and just building on these key themes Diane just mentioned, and what are you seeing from your perspective in the way that you're engaging with our client base today? Know you lead a high growth practice for Grant Thornton, and what are you seeing as it relates to what the clients are needing today?
Great question, Nichole. And inevitably in a recession, for some of our faster-growing clients, the top line stalls, begins to grow at a slower pace. And for some of our more normal market clients, they will actually see revenues declining as spend slows across the board. So it's critical that we as consultants, we as tax audit professionals, that we're always aware as to where our clients can get that next dollar of profitability. As the top line grows, inevitably as the top line contracts, inevitably that causes margins to contract if I can't decrease my costs quickly enough. So where we're preparing is products and services that are hyper-focused on where low-hanging fruit is to be able to decrease cost structure across the board in the event that top line growth stalls.
Okay.
And Nichole, just to dovetail on that, one of the things that, we're looking at in the U.S. economy and coming back from abroad, what's become an international theme is low interest rates or negative interest rates for longer have created almost some zombie companies out there, but a lot of debt on corporate balance sheets. And a lot of the debt in the U.S. is $9 trillion, about a third is junk. The next big tranche is just above that. So a slowdown in the revenues could mean downgrades. Certainly we hope our clients aren't in that, but they have to hedge against it. And the liquidity that shrinks up when you talk about managing margins, all of a sudden your access to your cushion, the credit markets, that door can close very rapidly, and that's something that we don't refinance their debt, but certainly them being aware of that when we're advising them because of the margin compression is really critical, especially in this particular expansion where corporate debt is where the overhang is instead of consumer debt.
Absolutely. Well, Diane, could you talk a little bit about the overall timing? So earliest and most likely time frames and factors impacting that timing, and then we'll build on it from there.
Well, the most humbling thing is economics is you can never time a recession. It usually has some kind of a news shock trigger. It may be the Fed went too far, but you hit a tipping point. It's really hard to time that. That said, we do have these red flags, and what we do have is a lot of things coming together. And speaking, globally, everyone keeps forecasting a rebound in global growth, a rebound, and they keep pushing that out. And the problem is because the cumulative effects of these trade wars and, frankly, just structural problems in China. China just can't be the engine of growth it once was. It's doubling down on its stimulus but not getting the same bang for the dollar on it. And so a lot of things are coming together in 2020. That doesn't mean we necessarily will have a recession in 2020, although I put it there because I think it's important to think about it, because that's where the risks are getting really high. And it's interesting is even though there were some people who got ahead of themselves and said, oh my gosh, we're going into a recession this year. Well, frankly, the pivot or pirouette by the Federal Reserve, the full turnaround from raising rates to now cutting rates, that has already helped consumers. They've refinanced, they've got extra cash in their pockets, it's eased credit market conditions, but it's not changed the fundamental issues that we face in 2020. And the Fed alone just doesn't have the tools, nor does any central bank globally, to counter the weakness that we're starting to see creep into our economies. And there's very few green shoots that actually have an ability to stimulate more aggressively, and they're not the economies that have enough, critical mass to really get us over the finish line. So it's that the risks are really rising. It was stunning to talk to these economists around the world and how many of them, although they don't forecast recessions. I've been a little bold here, but they all are very much agreed. 2020 is looking very, very risky.
Well, and Diane, even just as a side note, I hope you don't mind me sharing this, but the forecaster point I think really causes me to want to highlight and share with our team, because we are all very proud. But I just want to mention the great news that Diane received the Best Forecaster Award from her peers. And she has now won it twice, which is also a first for a woman in the group. And her award that we got to see, this beautiful silver platter, has 30 years of economist names engraved on it. So it is really amazing. And I just thought perhaps I could mention that at that very point when we're talking about forecasting, Diane. But heartfelt congratulations to you.
Thank you so much. It was stunning. In all fairness, I was the only woman in the group when I became the first president of the group since 1937, and the first American one in 2009. And I also got married in front of the group. But the other thing is we're now 20% female, so we've made great strides.
Wow. That's incredible. Well, definitely know that you are charting that path for everybody. So we are grateful. So in coming back to the points that Diane was talking about on the timing of a potential downturn, let's say, Robert, could you come back and cover, when we're speaking with our client teams, the types of conversations that we want to be having right now in light of the time frame that Diane just mentioned, and maybe talk a little bit more on the ways that we can help companies prepare today?
Yeah, great question, Nichole. As we've gone through time here in a very long expansion here, clients in general have gotten very focused on growth and have spent a lot of money growing their business. And as they've done that, a little bit of excess has creeped into their cost structure because the focus has been on the top line driving profitable growth. And it's been easy to make money. As the downturn does come, and it is inevitable that it comes at some point, as the downturn comes, it's going to be critical, again, that these CEOs know how to move their businesses quickly. And so our folks, one of the things that we pitch is a concept called the pursuit of perfection. Perfection's never a state that you ultimately achieve. It's a state in which you understand where you're falling short and make conscious decisions as to where to close that gap further. So it will be critical for CEOs in a downturn to know where those levers are that they can pull quickly and confidently to achieve near-term return on investment and margin preservation is probably a good way to word that. So we have our primary service in that space is a profitability assessment in which our consultants across all of our business consulting practice, for sure, and across even broader parts of the firm, execute these engagements in which, in a few short weeks, we can look at a client's business end to end and identify opportunities for improvement. And those opportunities then are looked at in terms of how much margin are they going to preserve, and how difficult is it to get to that savings. And those difficulties range on a number of different fronts. You certainly have to look at the economic pressure that's coming in, but more specifically, you need to look at how long is it going to take you to achieve results, how much is it going to cost to get there, how much capital do I have to put at risk, how likely are my customers and my employees to adopt the changes that are going to be implemented. So as we go through this process, it's critical, no matter where we are across the Grant Thornton stream of services, that we become more and more aware as to where our clients have opportunities to improve their business, and that we proactively engage CEOs and other C-level executives in conversations that stimulate a desire to close some of those gaps in the near term.
Robert, thank you. And what would your assessment be on the kind of the number of conversations we have had to date versus what you would expect to see as we move forward? I know you are at the heart of those conversations, so you would really have your finger on the pulse on are you getting a lot more calls right now because our teams are having these conversations, or would you say this is really more of a spark to kind of encourage everybody to have the conversations and team with you and our broader team in the firm?
Yeah, I think it's a little bit of both, Nichole. We're starting to see some of these conversations happen reactively at the request of our clients realizing that they're beginning to see some challenges. I expect that number to increase significantly as more signs of a recession become ominous. As we look at the global markets and CEOs looking to forecast their business, typically 90 to 180 days out, they need to have that visibility, and that visibility typically is not readily apparent. So they typically reach out to us, and when they do that, I expect to see our volume of these types of meetings as we react to the CEO's calls becoming probably 3 to 4 times what it is now. The proactive side, I think every time we have one of these calls, every time we have meetings in which we increase awareness within the firm, that really is the trigger of growth in those meetings today. So I would anticipate, whereas today we're probably doing 80% of these calls proactively, and trying to open our clients' minds as to where some of that low-hanging fruit is, and 20% is reacting, I expect that to flip completely to where we're spending a lot of time reacting to the market and CEOs recognizing on their own that they've got issues that need outside help resolving.
And so, Robert, as we close on our session today, maybe reorient us onto kind of the top 3 to 5 service offerings that are related to this area. You mentioned the profitability assessment. You touched on revenue optimization, cost optimization. I know you have really close teaming across the firm. So, for example, Chris Smith in the revenue optimization area. But kind of leave us with maybe these top 3 to 5 offerings that we ought to be thinking about and be very well positioned to share with our clients, and obviously our teams will reach out to you directly.
Absolutely. Let me start with the first, and I'll repeat the profitability assessment offering, which I am joined at the hip with both Chris Smith and Chris Stevenson as we look across our clients' businesses holistically. We look at 4 primary areas. We look at revenue and top-line growth, and in the case of a recession, top-line preservation. We look at direct cost of goods sold, and other things that go into making product. We look at optimizing overhead and the back office functions. And we look at something that Diane alluded to earlier, which is working capital and the debt that these companies have taken on. We look at the cash cycle and things of that nature, which have cash tied up, interest payments, interest expense associated with. So that really is the first, and that is something that we get laser focused, look at an entire business, and give a client 6 to 8 ideas for immediate profitability improvement. And to date, we have not failed to give them ideas in excess of 25 times our fees for those assessments. So that's number 1. Number 2 is an offering we call strategy achievement. Our clients are big, complex entities. They go to market with a number of different products and a number of different service lines and a number of different business units. And as they do that, they are not always intentional about carrying out corporate strategy, and a lot of work goes into that. Our clients, especially CEOs, spend a lot of time developing these corporate strategies, but those strategies don't get socialized and individualized down through the organization. So we have an offering that allows CEOs to better understand how they can take their existing strategy and get a lot more out of it, which becomes really important again in a downturn. And then the final piece, I alluded this earlier, is an offering we call the Pursuit of Perfection, and that is an offering around operational excellence. Vince Lombardi once said, "We will relentlessly pursue perfection, knowing all along we'll never achieve it, but along the way we will find excellence." And the general mentality there is we want to help our clients understand where perfection is. Again, you cannot achieve perfection, but you need to know where it is and where you're falling short so that you can look at each of those shortfalls individually and determine whether there's value in closing that gap a little bit more. And if you do this right, you have every head in the organization focused on their individual role and responsibility in driving continual performance improvement. We look at that, or we define that to some extent as reversing gravity. Gravity in our businesses, especially in a recession, is downward pressure on profitability. And what we try to do is get every eye in an organization focused on how you lift revenue, how you lift margins, how you reduce costs to the point at which you can run your business most efficiently. So those three in a nutshell are our three primary offerings. We are a tip-of-the-spear practice in that the projects we've done to date have led anywhere from audits to transaction assistance to big ERP implementations on the back end. Those things are more foundational and more things you do in good times, but the real bread and butter of this group and those three offerings is helping clients unlock profitability as quickly and confidently as possible.
Excellent. Thank you, Robert. I know our teams will be reaching out to you. And Diane, could I turn to you for, again, kind of closing thoughts on these top areas that our client-serving teams should keep in mind as they're engaging with clients and kind of following and trying to be proactive with these discussions?
Well, I think what some of the key issues are is, one, what is their debt situation and how will that affect margins? Because that's one of the sort of latent issues that is global in scope and can dry up overnight. So that's very important. The other issue is by sector. The housing market has gotten a little bit of a second wind, but it has peaked, and anyone involved in the housing market sector is going to feel the effects of that ripple through. The other issue is that I'm focusing on quite a bit right now is supply chain disruptions, and those are, like I said, the snowball at the top of the mountain that rolls down and gathers momentum and mass as it gets down to the bottom of the mountain. You want to be on top of it, not in front of it or behind it anyways. And I think that's one of the key issues that we're really tracking very closely is what's happening to your supply chain, and understand that the administration is looking at trade tariffs as a goal, not as a negotiating tactic. In fact, they've consistently risen. And the other important issue is that even as you try to divert trade to other areas, say Vietnam, South Korea, Thailand, which did occur, the administration has now set punitive tariffs on those countries because of the trade diversion, which is a natural response. We try to get stuff in through other places. Mexico, ironically, has been the biggest winner of the trade war with China because of diversion in trade to there. But as we know, already having a tentative agreement does not mean that we can't see a U-turn on a tweet in terms of tariffs. So really thinking about where is your margins going to be squeezed the most, and are you going to be able to do the same workarounds that you were able to do the first round of tariffs as they continue to gain momentum, and as there's sort of like a whack-a-mole effect of, chasing the suppliers around the globe. And the response, the reaction function, and talking to Germany recently and many German vehicle producers, they're already curbing production in the U.S. because of the tariffs that we have. They do expect punitive tariffs on them and their vehicle and parts as well, despite the fact that the EU actually has a surplus. We have a surplus with them, but, the administration is looking at bilateral trade flows. And these supply chain issues, if then, all of a sudden we see a hit to German production in the U.S., that's going to affect our clients as well. And so needing to stay abreast of the workarounds that worked maybe 6 months ago might not work in the next 6 months is, sort of that flexibility and nimbleness, and need to find alternatives is really important. So
excellent, Diane. You have given us so much to think about. And So, team, we will keep this podcast series going and obviously keep you apprised as we continue to move forward, knowing all of the uncertainties ahead. And I would really encourage you, in addition to the things that Diane and Robert just shared, also do know, and I hope you are following Diane on through the publications that she releases through the firm on her many updates, and